Markets do not break first because earnings weaken. They break because oxygen leaves the room. That is the truth I want to start with, because most people still think the stock market is mainly a scoreboard for corporate performance. They look at earnings, margins, guidance, and buybacks, and they think those numbers are the whole game. They are not. They matter. But they are not the thing that decides whether the machine keeps breathing. Liquidity decides that. Liquidity is oxygen. And when the oxygen lines start being rerouted, hoarded, weaponized, or withdrawn, a market that looked healthy can suffocate much faster than the crowd expects. I have spent my life around capital, and I do not say this lightly. There are only a handful of times in a long investing life when all your instincts light up at once. Not because of noise, not because television is excited, not because some economist found a new chart to scare people with, but because the structure itself starts shifting under your feet. That is what matters now. The structure, not the slogan, not the soft landing chant, not the idea that America always finds a way, the Fed always rides to the rescue, and China is always just one more headline risk the market will eventually absorb. The dangerous thing about this moment is not one event. It is the oxygen map for 30 years. The world acted as if the oxygen lines were permanent dollar reserves, Treasury demand, American capital markets, globalized supply chains, Fed credibility, cheap debt, deep liquidity. All of that felt like weather always there. Hardly worth examining unless you were a macro obsessive. That was a mistake. Because systems people treat as weather are often just policies and incentives that lasted long enough to feel natural. And anything built on incentives can change. The source you gave me begins in exactly the right place. It says the single most important variable in global markets is not earnings and not rates in isolation. It is liquidity. It then identifies what China is doing as the most deliberate structural challenge to the old dollar liquidity framework in decades, especially after watching Russian reserves get frozen and deciding that dollar assets can become hostages instead of reserves. It also ties that move to gold accumulation, yuan settlement, bilateral swaps, a domestic deflationary property bust, U.S. refinancing stress, and a Federal Reserve trapped by inflation. That is the real backbone of the piece. And that is the backbone I am preserving here. Fay file a site, Fay turn 42, file 0, Fay once. You understand that the first question changes, you stop asking. Will the market be okay? You start asking, where is the oxygen coming from? Who controls it? And what happens if the lines start moving? That is a far better question. It is also a more dangerous one because it forces you to admit that markets can keep rising while the plumbing underneath them is weakening. The line on your screen can look stable long after the foundation has become unstable. Investors hate that idea because it means comfort is not proof. It means a calm market can still be a market in the early stage of suffocation. That is why I want to lay the whole thing out in plain English. For decades, the United States sat at the center of the oxygen system. The dollar was the world's reserve currency. Global trade ran through it. Treasury markets absorbed the world's savings. When pressure hit the system, money ran toward America, not away from it. That gave the United States something extraordinary. It gave it the power to borrow at a scale and a cost structure that almost no other nation could sustain. People mistook that privilege for permanence. Nothing in finance is permanent. When politics, debt, and strategic fear enter the room together. The source describes China's shift in exactly the terms that matter. After seeing what happened to Russia, China's leadership made a cold decision that dollar reserves are not just assets. They are exposure, they are vulnerability. They can be sanctioned, frozen, and used as leverage. So China began something bigger than a tactical portfolio adjustment. It began slowly reducing its dependence on the dollar system by buying gold, building bilateral currency arrangements, promoting yuan settlement in trade, and developing parallel financial rails that are less exposed to U.S. control. That is not a rumor. That is a national balance. Sheet strategy, Fay file site, Fay turn 42, file 0, Fay. Now stop and respect what that means. The second largest economy on earth is not simply arguing with America. It is redesigning its oxygen supply. That is not a diplomatic spat. That is strategic respiration. And when a system as large as China starts changing how it breathes, the rest of the world eventually feels the pressure. This is the part the average investor misses because he is trained to look at visible conflict, tariffs, export controls, angry statements, summit meetings. Those are the surface ripples. The deeper move is much colder. China is trying to reduce the number of places where the U.S. can put its hand over the oxygen tube. That is why the transcript focuses so much on gold purchases, yuan internationalization, bilateral swap lines, and parallel settlement structures. Look at them one by one and they feel incremental. Look at them as a system and they say something very different. They say China no longer wants its survival to depend as heavily on a pipe it does not control. Fei Phalocite, Fei Turn 42, File 0 Fei, that alone would be important, but it becomes much more dangerous when you layer in China's domestic problem. This is where the crowd gets confused. They assume a country under domestic economic pressure becomes more compliant, more financially cautious, more eager to protect the old order. Sometimes that is true, but domestic pressure can also harden strategic intent, especially in a system run by leadership that thinks in decades, not election cycles. The source is clear about China's internal stress. It describes the property sector as a slow-motion collapse that still has not been sustainably stabilized, even after years of policy support. It describes property and land sales as central to household confidence and local government finances. It describes deflationary pressure, damaged confidence, and an economy that exports weakness to the rest of the world when its internal demand is failing. This matters because China is not making these monetary and geopolitical decisions from a position of serene domestic health. It is making them while sitting on a domestic deflationary time bomb, Fei Phalocite, Fei Turn 42, File 0 Fei, that combination is combustible. A country under domestic property stress and deflationary pressure has every reason to value strategic monetary flexibility more, not less. It needs room, it needs optionality. It needs to reduce the number of ways an external rival can tighten the tube. This is why I do not buy the lazy argument that China is too rational to push this confrontation far, because it needs the system too much. Rationality does not always mean preserving the old system. Sometimes rationality means building a new breathing route before the old one becomes a weapon. That is the lens I want you to use. Now bring that across the Pacific, because none of this matters for markets unless it meets a vulnerable target, and the United States has made itself much more vulnerable than the public conversation admits. The source states the target clearly. Treasury supply is exploding. The U.S. fiscal deficit is enormous. Even in peacetime, debt issuance is massive. At the same time, one of the world's largest structural buyers of treasuries is deliberately reducing exposure. That is not a small portfolio story. That is supply and demand in the most important bond market in the world. More paper coming, less enthusiastic foreign demand. That means one thing, unless somebody else fills the gap at the same price, yields rise. And when yields rise in a debt-soaked world, the pain does not stay in the bond market. It reprices everything. That is the next oxygen lesson. Treasury yields are not just numbers on a terminal. They are the oxygen pressure in the whole system. When the oxygen cost rises, weak lungs start failing first. The source then turns to exactly the place where I think the weakness is most underestimated, the middle tier of corporate America, not the cash. Rich giants that dominate headlines, not the fantasy names people love to hate, the middle, the companies that borrowed heavily when money was cheap, that are too large to be invisible but too weak to absorb a brutal refinancing shock cleanly. It points to sectors like commercial real estate, retail, media, healthcare services, and other leveraged businesses that issued debt in one rate regime and now face another. Debt that rolled at 4% or 5% does not feel the same at 8% or 9%. That is not a footnote. That is a business model event. Fei Phalocite, Fei Turn 42, File 0 Fei. This is what I call the refinancing choke. And the refinancing choke is where a lot of innocent-looking balance sheets reveal that they were only alive because oxygen was cheap. That is the dangerous misunderstanding in modern markets. People think higher rates are just a valuation issue. They are not for a heavily indebted business. They are a survival issue. They determine whether interest stays a manageable line item or turns into a predator inside the income statement. This is why I am so suspicious of cheerful talk about resilience. A great deal of resilience in the last decade was rented from the zero-rate era. It was not all fake, but it was heavily subsidized. Cheap debt can make a marginal business look disciplined. It can make weak capital allocation look acceptable. It can make mediocre management look competent. When that subsidy vanishes, the real quality of the business starts showing up, and quality is usually lower than the market wants to admit during long, easy cycles. This is where the oxygen map and the credit map merge. China weakens dollar system demand at the margin. Treasury supply keeps rising. Yields stay high or become more unstable. Corporate refinancing costs worsen. Credit spreads widen. Hiring and investment weaken. Consumer confidence softens. Revenue misses start appearing. Then valuation multiples compress on top of the earnings disappointment. That is the doom loop the transcript describes, and it is a perfectly coherent loop. Wider spreads hurt investment and hiring. Weaker hiring hurts spending and confidence. Weaker spending hurts revenues. Weaker revenues make leverage more dangerous. More leverage stress widens spreads further. That is not drama. That is reflexive suffocation. Price and reality start feeding each other in the wrong direction. Fay Phyllosite, Fay Turn 42 File 0 Fay. This is why I care so much about the Fed. Constraint. The crowd still lives mentally in the old regime, where serious market weakness meant the central bank could cut, flood the system, and restart the oxygen flow. The transcript is right to say that the old playbook only works freely when inflation is truly under control. And inflation is not structurally under control in the way the crowd pretends. Headline numbers cooled from the peak. Yes, but the deeper forces remain: deglobalization, energy transition costs, fiscal excess, labor friction, supply chain duplication, geopolitical fragmentation. These are not one-quarter anomalies. They are sticky oxygen costs in the system. Fay Phyllosite, Fay Turn 42, File 0 Fay. That is why the Fed feels trapped. If it eases too aggressively, it risks reigniting inflation and damaging credibility. If it stays tight while the refinancing choke worsens, it accelerates the credit damage. That is not a Fed put. That is a constrained doctor with a weaker medicine cabinet. Markets priced on the assumption that the old rescue is always available are going to hate that realization. Now let me talk about the technology war layer, because this is one of the most load-bearing parts of the transcript and one of the least appreciated by investors who still think this is just a trade dispute. It is not a trade dispute. It is an oxygen war over future industry. The source says this explicitly: export controls on advanced semiconductors and chip-making equipment, Chinese countermeasures on rare earths and critical materials, supply chains being forcibly duplicated and rerouted, hundreds of billions of dollars of industrial rebuilding. Not because this is efficient, because strategic dependence has become intolerable to both sides. Fay Phyllosite, Fay Turn 42, File 0 Fay, that has two consequences investors keep underpricing. First, it is inflationary. Rebuilding duplicated supply chains is expensive. Strategic redundancy is expensive. National security industrial policy is expensive. The old globalization regime was disinflationary, partly because it ruthlessly optimized cost. This new regime optimizes resilience and control. Those are worth having, but they are not cheap. Second, it makes the whole global system less elegant and less liquid. Money, materials, equipment, and know-how stop moving through one frictionless network and start moving through competing blocks with political conditions attached. That does not just raise costs, it raises uncertainty. And uncertainty is a hidden tax on valuation. This is why I think the market is much too relaxed about the phrase deglobalization. People hear it and imagine a slow cultural shift. In reality, it means the oxygen lines are being rerouted, duplicated, and fought over. That is an entirely different scale of consequence. The transcript also does something intellectually honest that I respect. It gives the bull case: China may be rational enough not to trigger a truly destabilizing confrontation. The Fed may still manage a meaningful easing path if inflation behaves. The U.S. consumer may stay stronger than pessimists expect. Fine, those are not stupid arguments. I take them seriously. I do not confuse my concern with certainty. Certainty is expensive in markets, but that is exactly why the transcript's real point matters so much. It says the probability distribution has shifted meaningfully to the downside while the market is not pricing that shift correctly. That is the entire game in macro. You are not waiting for certainty. You are asking whether the odds changed and whether price reflects that change. The source's answer is clearly no. Price does not reflect it. Fay Phyllosite, Fay Turn 42, File 0 Fay. That is why the opportunity is asymmetric. Not because disaster is guaranteed, because the downside probability is larger than the market is honoring. That is the kind of situation I take seriously. Now let us talk about XI, because the transcript is right to stress that Western investors keep making the same error with China. Leadership, they analyze Beijing as if it were just another quarterly growth management team. It is not. Xi is playing a much longer strategic game. He is willing to accept short-term pain if it reduces long-term dependence on American power. The source says exactly that and ties it to the 2049 horizon. That matters because market participants raised inside democratic cycles keep underestimating how much pain an authoritarian strategic rival is willing to absorb if the prize is structural independence later. Fei Philosite Fei Turn 42 File 0 Fei that changes how you should read Chinese decisions. You should stop asking whether they are immediately market-friendly. You should ask whether they improve China's control over its own oxygen lines. Once you do that, a lot of behavior that looks self-defeating in the short term starts looking completely coherent. That is where the market gets blindsided. Now, the transcript does something else I think is valuable. It becomes specific about what to watch: investment, grade CDs, Treasury auctions, foreign participation, the yen, the yuan. Those are good choices because they are oxygen gauges. If investment, grade credit protection, starts moving for reasons beyond ordinary rate volatility, it tells you sophisticated credit investors are beginning to smell the refinancing choke. If Treasury auction demand weakens in a visible way, it tells you the world's oxygen price is changing in real time. If the yuan devalues sharply or the dollar spikes in a panic, while the long-term structural trust story is weakening, you get the kind of contradictory pressure that often detonates weak balance sheets. Fei File Site, Fei Turn 42, File 0 Fei. These are not random market indicators. They are stethoscopes. They tell you how the system is breathing. And if you are serious, you should learn to listen before the patient is obviously gasping. Now let me tell you how I would think about positioning in a Buffett-style framework, because I do not want to become some macro theater actor shouting doom and then vanishing before capital allocation begins. The transcript's own positioning language is more Soros. Like with long volatility, shorts in specific credit exposures, tactical dollar positioning, gold, and high cash, fine, the logic is sound, but if I translate that into the style of an allocator obsessed with asymmetry and survival, it becomes simpler. First, I do not want too much exposure to the expensive leverage, sensitive parts of the market that depend on the old oxygen regime. Second, I want meaningful exposure to things whose value is not purely a function of continued faith in low inflation and endless credit ease. Gold is the obvious first candidate. The source is right there. Gold is not a prediction of apocalypse. It is oxygen insurance against monetary credibility weakening. Real energy assets deserve respect too, because they sit near the center of any inflationary or geopolitical repricing. Fei Felicite Fei Turn 42 File 0 Fei 3rd. I want liquidity. Real liquidity. The transcript says cash is optionality, and that is exactly right. Cash in a difficult regime is not just a zero return placeholder. It is the right to act while others are trapped. It is the right to buy when forced sellers appear. It is the right not to become a seller yourself at the worst possible time. That right becomes more valuable as the system becomes more unstable. Fei File Site Fei Turn 42 File 0 Fei 4th. I want humility. You do not have to predict the exact week or month. The transcript is admirably honest that the precise catalyst could differ, and that the timing window could be first half or second half of 2026 or beyond. Fine. Exact timing is overrated by people who want to sound clairvoyant. What matters more is recognizing when the oxygen map has changed and refusing to stay overexposed to assets priced as if nothing important is changing. Fei Felicite Fei Turn 42 File 0 Fei. That is a much more useful discipline, not prophecy. Preparation. This is where I need to say something blunt to you. Most people will do nothing with this information. They will nod. They will say it is interesting. They will tell themselves they will keep an eye on it. Then they will go right back to the same crowded positions, the same passive assumptions, the same faith in the Fed, the same exposure to valuation, the same dependence on long-duration stories, the same refusal to hold enough liquidity, the same contempt for insurance when insurance still feels cheap. That is how complacency wins, not with debate. With inertia, the transcript ends in exactly the right emotional register. It says, complacency is everywhere. That is true. Complacency always grows in the same kind of soil. A long cycle where every shock was solved, every dip was bought, every rescue appeared in time, every structural warning felt early until it was suddenly late. That is the soil markets have been growing in for years. That is why so many people are still looking at this through the tools of the old regime. And that is precisely why the shift is so dangerous. Fe Felicite Fe turn 42 file 0 Fe, the world changes gradually enough that your old framework still seems usable. Then one day it does not. I have seen that enough times to respect it. And I respect it now. So here is the final test I want you to run on your own life. If the oxygen lines tighten, which of your assets still breathe on their own? If Treasury demand weakens, which of your holdings are least dependent on endlessly falling or stable? Long-term yields if refinancing costs bite. Where are you exposed to the middle-tier corporate damage? The source describes, if the Fed cannot run the old rescue playbook cleanly, which of your assumptions fail first? If China keeps pulling away from the old dollar architecture, what in your portfolio becomes more fragile and what becomes more valuable? If you cannot answer those questions, you are not diversified. You are merely comfortable, and comfort is often the last luxury a market takes from people before it takes something bigger. You can keep behaving as if the old oxygen system will stay intact because it has been there your whole investing life. Or you can accept that the pipes are being rerouted, the pressure is changing, and the intelligent move is not to panic but to prepare. That means fewer blind assumptions, more real assets, more dry powder, more awareness of credit, more respect for currency and treasury, market signals, more willingness to look foolishly cautious before the crowd discovers caution was the cheaper choice. That is how serious capital survives big transitions. Not by perfectly predicting the date, by refusing to pretend the map has not changed because it has. And if you wait until everyone agrees it has changed, you will be reacting inside a world where the oxygen is already thinner, the prices are already worse, and the options are already fewer. Do not do that to yourself. Do the work now, think independently now, and above all, stop wearing paper as if it were armor. It is not in a world where the oxygen itself is becoming a strategic weapon.